Hello and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's panelists are Alan Bush, our Senior Financial Economist, and Mark Soderberg, our Senior Ag Market Specialist. Starting with the grains, Mark, with all the volatile weather across the Midwest this weekend, why are prices so weak?
Yeah, weather-wise, it's certainly been a crazy couple of weeks. Last week, or late last week, I saw firsthand the impact of heavy rains on some of the recently emerged crops in southeast South Dakota and southwest Minnesota. Several road closures, rivers, and streams out of their banks. And once our plane got airborne, a lot of ponding in the fields. We also had a lot of other areas in the northwestern corn and bean belt that also were faced with much above normal precipitation, likely drowning out some of the crops while fertilizers run off, therefore becoming less effective in disease pressures. We also had, but areas that had the heaviest amount of rain late last week will likely have the little moisture this week, allowing fields to dry out a little bit. Here in the central Midwest and eastern Corn Belt, dry and much above normal temperatures last week. They had moderated a touch, and I thought the rain event this past Saturday night into Sunday morning did provide a little bit better coverage than expected, at least in northern Illinois and much of Indiana. I think that's what tilted prices lower here to start the week. Do look for lower ratings tonight, however. In order to see prices work lower from these current levels, I think you're going to need to see better coverage of rains in central Illinois and into the southeastern corn and soybean belt. December corn right now trading back below 45. I think it's getting overdone to the downside, trading to its lowest level in nearly 3 years now, with big USDA reports here coming up this Friday.
All right, there's a big USDA report this Friday. Are there any historical price tendencies you're seeing?
Yeah, price-wise, there's definitely been a bit of a bearish lean in feed grains for this late June report. Corn prices since 2000, they have closed higher only about a third of the time, with nearly two-thirds closing lower. There was 1 year where prices closed actually unchanged. The past 2 years, prices broke over 30 cents on report day. However, it was up a 40-cent limit here just 3 years ago. And in wheat prices, a little bit getting overdone to the downside right now, but we do have a little bit of a bearish lean on report day as well. 60% of the time prices close lower, 40% of the time prices have closed higher on report day. But when you look out for the next week or so, week beyond the report, it comes a little bit more in balance, where we've seen prices above pre-report levels 50% of the time and lower 50% of the time. Beans, on the other hand, a little bit of a higher tilt with prices closing higher 57% of the time on report day, so down 43%. Last year and in 2021, Nov bean prices surged over 6% on report day. And now last year, this was due to acres falling much more than pre-report expectations.
Well, continuing with Friday's reports, what are your expectations?
I look for corn acres to come in at 90.3 million. That's up 300,000 from the March intentions, yet still down over 4 million from a year ago. In beans, I've got acres at 80.1. That's down 400,000 from the March intentions and about 650,000 below the average trade guess. So I'm looking for a little bit more of prevent planting here in this year's soybean crop. For the March 1st stocks, I'm at 4.97 on corn, 981 million bushels on soybeans, both slightly above the average trade guess. On wheat, I'm at 705 million bushels. While this is among the highest of the range of estimates, it's still only 20 million bushels above the average trade guess, so kind of a tight range here. I just think the USDA export forecast here is a little bit high, with only 1 month left of census data to round out the 23-24 marketing year.
All right, thanks, Mark. Alan, what is the outlook for the SEP 30-year Treasury bond futures?
Okay, the September 30-year Treasury bond futures are currently trading within the parameters of a 7-day triangle congestion pattern. Some could refer to this as a pennant pattern. So historically, prices break out of a congestion pattern approximately 60 to 65% of the time in the same direction that they came into the pattern. And that suggests futures will break out of the pattern to the upside. Also, this is in keeping with the fundamentals, which suggest that a slowing U.S. economy and a Federal Reserve that is likely to pivot to accommodation in September will also support the upside. So either way, the fundamentals appear to be supportive, and the technicals also suggest higher prices.
All right, moving over to currencies. Why has the US dollar held up so well despite prospects of the Fed lowering interest rates 2 times this year?
Okay, so interest rate differential expectations are currently only neutral for the US dollar, since many major central banks this year are also moving to accommodation. In fact, several have already cut rates, including the European Central Bank, the Swiss National Bank, the Bank of Canada, the Fed, and the Bank of England will be cutting this year. So there's really no interest rate differential advantage in any of the currencies right now. So what has really supported the dollar is the flight to quality influence. This in light of political uncertainties in Europe and ongoing tensions in the Middle East. So although the greenback is lower today, it is likely that these geopolitical issues are likely to persist for quite some time and will remain a longer-term bullish influence on the greenback.
Right, Alan, lastly, what potential market-moving economic reports are scheduled for this week?
Okay, on Tuesday, we'll have the June Consumer Confidence Index guessed at 100. Thursday, first quarter gross domestic product anticipated to be up 1.4%. And then on Friday, May personal income predicted to show a 0.4% increase.
All right, thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views and opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com. Thank you.